Create a 3 minutes video for YouTube about cash and cash equivalents, the silent power of liquidity. Every investor dreams of growing wealth, but not every dollar is meant to chase returns. Some money has a different purpose. It's there to protect, to provide stability, and to give you freedom when life throws surprises. Welcome to Fiscal Forge Academy, where we simplify investing and financial strategy. Today, we're unpacking one of the most underrated but crucial parts of any portfolio: cash and cash equivalents. They don't make headlines, but they keep your financial engine running smoothly, no matter what's happening around you. When people hear cash, they usually think of money in their wallets or bank accounts. But in the world of finance, the term goes much deeper. It includes physical money, savings accounts, treasury bills, money market funds, certificates of deposit, and even short-term corporate loans called commercial paper. What all these have in common is simple. They're safe, liquid, and always ready when you need them. If investing were a football match, cash and cash equivalents would be the goalkeeper. They don't score goals, but they make sure you never lose the game. Now, for any asset to qualify as a cash equivalent, it must meet 4 key conditions. It has to be highly liquid, meaning you can turn it into cash almost instantly. Short-term, typically under 90 days. Low risk, so its value doesn't fluctuate much. And predictable, meaning you always know what it's worth. These features make cash equivalents the ultimate financial safety net. Quiet, reliable, and always there when you fall. Let's break this down quickly. Physical cash is the most direct form of liquidity. No bank, no delay, but it earns nothing and loses value to inflation every single day. Think of it like ice melting in the sun. It's there when you need it, but it slowly disappears in value. That's why most people prefer bank deposits and savings accounts. They're safe, insured, and they earn small interest while keeping your money accessible. In Kenya, competitive accounts can offer between 8% and 13% interest, while in the US, high-yield accounts average around 4%. It's not life-changing, but it helps your cash keep up with inflation. Then there's the Certificate of Deposit, or CD. You lock in your money for a fixed time, maybe 3 or 6 months, and earn a guaranteed return. If you pull it out early, you pay a penalty. Smart investors use a CD laddering strategy, staggering different maturity dates, so part of their money is always freeing up while the rest earns better rates. Next, money market accounts and money market funds. A money market account works like a savings account but usually pays a little more. A money market fund, on the other hand, is an investment product, a pool of ultra-short-term securities like treasury bills or commercial paper. They're great for temporarily parking large sums. Many global corporations use them to hold excess cash while earning a safe return. Treasury bills are perhaps the gold standard of safety. Short-term government securities backed by full government trust. They're sold at a discount and redeemed at full value, giving you a predictable profit. As of 2025, T-bills in the US paid around 5% and in Kenya roughly 8 to 9%. Safe, flexible, and reliable. That's why they're the backbone of liquidity management worldwide. Then we have commercial paper, short-term corporate debt issued by big, trusted companies to meet short-term funding needs. For example, a company like Safaricom or Coca-Cola might issue commercial paper to pay suppliers or manage inventory. It pays a bit more than treasury bills but carries slightly higher risk since there's no government guarantee. So why hold cash at all when other investments pay more? The answer is simple: stability. Cash and cash equivalents are the oxygen of your financial system. You don't notice them when things are good, but you can't survive without them when things go wrong. For individuals, this is your emergency fund, usually 3 to 6 months of expenses kept safe and accessible. Lose a job, face a medical issue, or need urgent repairs. This fund keeps you from going into debt or selling investments at the wrong time. For companies, cash means operational survival. paying employees, suppliers, or seizing quick opportunities. And for governments, it ensures short-term liquidity and economic stability. Think back to the COVID-19 pandemic. Businesses with strong cash positions stayed afloat or even grew, while those without reserves collapsed. But cash isn't perfect. Its biggest enemy is inflation. When prices rise faster than your savings, your real wealth shrinks. Another downside is opportunity cost. By holding too much cash, you miss out on higher return investments like stocks or real estate. Historically, equities have earned around 10% annually, while cash barely keeps up with inflation. Holding too much cash means safety at the cost of growth. There's also interest rate risk. When central banks lower rates, new savings accounts or T-bills yield less, so your returns shrink. To manage that, investors use laddering, spreading investments across different maturities, so there's always some portion ready to reinvest when rates change. So how much should you hold in cash and equivalents? It depends. For most people, 5 to 15% of your total portfolio is enough for emergencies and short-term goals. Retirees or conservative investors might keep 20 to 40%, enough to cover 2 or 3 years of living expenses without touching long-term investments. Remember, cash isn't there to make you rich. It's there to make sure you never go broke. It's the foundation, not the growth engine. It gives you peace of mind, flexibility, and the confidence to make smart moves when others panic. In investing, safety isn't about avoiding risk. It's about being ready for opportunity. Liquidity gives you power. The power to stay calm, the power to act fast, and the power to keep your financial plan alive through any storm. So as you build your portfolio, don't ignore the quiet power of cash and cash equivalents. They're your defense line, your reserve, your freedom fund. Because true wealth isn't just about how much you earn. It's about how prepared you are when the world changes. Thanks for tuning in to Fiscal Forge Academy. If this helped you understand your financial foundation, hit subscribe, share it with someone building theirs, and join us next time as we explore fixed income investing, where safety meets steady growth. Until then, stay smart, stay steady, and keep forging your financial future. Settings: add clean subtitles with no outline.